Howdy, Jacob here. Today we're looking at A10 Networks in the software industry. 1.1 billion market cap on 951 million enterprise value. Just over $1 billion. Let's see what insider ownership is. 2.6%. So not a lot of insiders owning the business. Growth is not terribly sexy. We're looking at maybe 5%, 4% CAGR over the last 10 years. But they have become more efficient, so that's a positive sign. Gross margins increasing. Operating margin went from negative to mid-teens, so pretty impressive there. Paying a dividend, not sure how I feel about that. We'll have to see. Return on invested capital, very positive. Balance sheet shows 97, 62, about 159 million cash-like products with no short-term debt, no long-term debt. Very positive signs. On the balance sheet, they have very healthy cash balance compared to debt. And free cash flow production, absolutely amazing. The last 4 years, a little bit of reinvestment, which you can see through capital expenditures going from low single digit to about 11 million in capex. And use of cash is 18 million on the dividend side, which is about 30% of their 5-year average free cash, 4-year average free cash flow, and share repurchases with the rest, pretty much the rest, with leaving a little bit of money for reinvestment. So, I think I'm ready to make some assumptions here. Don't know what else I need to look at. So for revenue, I feel pretty comfortable with a 6% and good return on invested capital. They're not reinvesting back too much. So maybe a little bit above the market average. Margins, I'll be going pretty close to what they've been recently. Maybe let's do 16, 15. And for share change, they have been repurchasing quite a bit of shares. So 1% would be about 11 million. Offset stock compensation, 25 million. They can afford that. So let's assume 1% share repurchases. 25 million is about 50% of their free cash flow. Dividend, they can increase that, but I don't want them to. So let's keep that the same. So this is leaving about 25 to 30% of their free cash flow available to reinvest, make acquisitions, and they don't have any debt, so no concern there. But they're basically leaving 25% of cash to be able to get this type of revenue growth and these type of margins. And we're saying it needs to fall 57% to get to the return we're looking for here. And I think it's a very solid company. I think there's big decline recently, but I still think there's easily mid-single digit growth likely ahead of them. And this dividend payout, interesting. I'm not sure how I feel about that. I feel like they're small enough. They have investment opportunities to make that at least historical 20% rate of return. I definitely prefer they be doing that than paying it to me as a dividend. But, with these assumptions, feeling pretty comfortable, just not price-wise very comfortable yet. So hopefully you enjoy the video, Grace.